Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. It's Friday. It's May 6th. The market's going to open up in about an hour, actually in almost 2 hours, an hour and 50 minutes. Boy, as you can see here, we're taking it under the chin before the market opens. We did have a little bit of a reprieve yesterday from a 3.5% move on the S&P, which almost undid everything from the day before. Actually, it undid everything from the day before. We're still above the all-time lows on the S&P and on the Dow. The Dow, we still have several lows. We actually are higher than the previous low and the previous low that happened in February and the previous low that happened just a few days ago. But we're at the bottom end of the range, and to me, this feels like a major shakeout. The Nasdaq took out a low, but you have divergence like here and you have divergence here. I mean, this is really telling us that this market can't take it anymore, and I'm expecting the market to go higher. Now, I was looking for data that really caused this, and honestly, it just seems like a technical shakeout. There's just not that much data. I mean, it looks like investors just overnight completely changed their sentiment, but nothing really changed. And I'll go ahead and look. I mean, it could be earnings, that earnings really hit really bad in one day, but what I'm seeing and I'm smelling is a shakeout, all right? A big shakeout with stocks moving higher, which is typically what happens near these levels. We should see a lot of volatility and stocks getting ready to shake out the weak hands and move higher. Now, let's talk a little bit about global economy, and then we'll start at the sectors. Fear spread, U.S. interest rate hikes to fight inflation might stall economic growth. That's a day after the Fed said they're not going to go 0.75 of a basis point, and they think they can get out of this without a recession. But I'm just saying, S&P plunged 3.6% on Thursday as optimism that drove the previous day's rally evaporated. Again, I still can't really find a good reason for it, other than earnings and technicals. Investors worry about whether the Federal Reserve, which raised its key rate by 0.5 percentage point on Wednesday, can cool inflation without tipping the U.S. economy into a recession. That's a big factor, but it's not like that factor didn't exist on on Wednesday. Traders were briefly encouraged by the chairman Jerome Powell's comments that the Fed wasn't considering even bigger increases, but the market went down anyway. It's very strange. Today we have the employment data, which has been fairly solid. We'll see that comes out at 8:30 in the morning in about about 45 minutes from now. You should be getting that report. And as far as what we're to expect, let's just take a look at what's on the table, and we can get a really good idea of what we can expect. So we're looking from 300 to 500 unemployment, about 3.6. If unemployment is much higher than that, it could be negative, but honestly, the numbers are pretty tight, and even the non-farm payroll, the numbers don't look that bad. I don't think the number will be really outside of the 400. I honestly don't. So I don't think this report will have a major influence. Bond market, oh boy, we fell off the cliff, but again, we're having this divergence. We're having divergence in bonds and stocks. I haven't seen that in a long time. And again, divergence occurs when you're seeing lower price, but the oscillator says no more, and it goes the opposite. And we're seeing that on stocks and bonds, as you can see here. Higher, lower, really heating up the last few days, as you could see here. I mean, it's just going to a whole new level, and you're seeing that divergence here. Higher, lower. That typically means there's a turning point, but we couldn't stay within this box. I'm hoping within the next day or two we're going to go back into this box, but I'm glad I did not go long bonds because we would have been hurting really bad. I'd love to see a rally to about the 130 level, maybe the 135 level, and I would sell them then. But this, to me, seems like it's too much too fast. And the fact that the bond market's been going down and the stock market's been going down, and I think the bond market's overdone, which leads me to believe that the stock market is overdone. And again, this divergence is classic. I mean, this is huge. Volatility did not go above the three previous peaks. The first one on the 26th, the second one on the 29th, and the last one, 6th of this month, which was yesterday. Again, that's telling us that volatility is not getting out of hand, and we're probably more than likely going to cool off and go back down, not up. Put the call ratio, again above 114, We've been, look at this. These are, I just want to show you the 70 levels. This is, anything below this means we're overbought. Anything above this means we're oversold. Anything in here is random noise that should be just not paid attention to. Notice since November how many times we went to the call side. Not one time since November 5th. But look at how many times we've been to the put side. I mean, almost every day except right here when we rallied a little bit, right? So again, we're coming to the overstretched level. And again, folks, we're coming off of 133. That's a high level. I mean, look at this level. 3 years, highest level in 3 years on a weekly basis. On a 5-year basis, look at this. 2018 was the last time we were here. Folks, we couldn't get our levels up here on COVID. I'm just letting you know. So we're still there on a weekly basis and we're coming off. So put the call ratio, if it comes off and if this starts coming back down, that'll be a very bullish sign for the overall stock market. So again, put the call ratio is telling us we're stretched out. Volatility is telling us we're stretched out, and the fact that we haven't gotten higher in 3 days is positive. The Dow Jones, we could not break lower yesterday. That's a positive sign, and I'm hoping we're going to go a little higher today than lower. But overall, I think we are stretched out. Sector-wise, we're still very, very defensive. But if you look at most of these sectors, you will see energies just continuously making highs. Utilities looks like they've sold off enough and they're going to go higher, especially if the market's going to be in danger zone. Consumer staples looks like they've had enough. Basic materials, I'm loving right now, except for the volatility, but I'm loving basic materials. Look at how close they are to all-time highs, right? I mean, that's great. And I mean, that's a no-brainer right now. Technology, big question mark. Industrial, I think, is going to start picking up. Real estate, I think, is going to stay choppy. Healthcare, I think, is going to start moving a little bit higher right now. Consumer discretionary, I just don't know. That's a big question mark. Financial, I think, are going to start getting a little choppy. And communication services, this is very interesting, but communication services seems to be picking up relative strength. Now, I want to show you guys something. Notice it's making higher highs. It did not break down here. That's very, very important. Notice technology broke down, right? But communication services did not. Now, if you look at these sectors, look at the weakest sector, communication services, right? So let me go back a month. Communication services. Let me go back another month. Communication services. Let me go back another month. Communication services. Now we're in January 31st. But if we go now, today, and if you look at the charts, and again, it's still registered on a let's see on a non-cumulative basis how it's registered, out of curiosity. Nope, it's already number 2. See, that's what I just caught. My eyes caught it before this, but on a cumulative basis, it's still the weakest, but on a monthly basis, it's not. And this is the sector that caused the market to go down. And again, if you look at the chart, notice this. This is key here. It's these little nuances that make a big difference. Higher highs. Discretionary broke down to low. Tech, I think, broke down to low. Let's find it. I'm pretty sure it did. Yep, broke down almost at the bottom, but it broke down yesterday's low. But look at communication services. So these little nuances are telling me that we may be having another sector rotation, and communication services have been some of the most bearish stocks. For example, let me just show you real quick if this thing works for me. I hate when it doesn't work. Not good. It's not working right now. Let me see if I can get it to work. But the most bearish stocks, Stock Fetcher doesn't look like it's working. It's been working pretty good. Let's see if I can get it to work. Well, while it's loading, just so you could see here, if you look at sectors, I want to show you this. This is a heat map. It's another way of looking at it. If you look at industry ranking, actually, no, that's not it. That's not it. Let me go here. If you go right here, heat map. This I call this my visual heat map. But if you look at it, you will see that over the last 5 days, communication services. Now let's see if we can get Stock Fetcher to work. All of a sudden, it just decides it doesn't want to work. Huh. Let's see, maybe on another thing, or no, doesn't want to work. Doesn't want to work. All right, so we'll have to show you this. But as you can see here, communication services are starting to go higher over the last 5 days. Let's see over 30 days. Nope, still there. But over a 5 day, it's starting to lead. So it'll be very interesting to see if that stays the way it is. But the reason why I wanted to show you is because PayPal's in here, Zoom is in there, a lot of stocks that have been really, really, really on the sideline. So if the communication services comes up, that could be a big, big turn in the market. Now, I know the markets have been going crazy, but we've been taking profits. Let me show you some gains we took this week. ConocoPhillips yesterday for a 22% gain. We were holding this sucker for 34 days. Now, we got into this stock on 4-1. Right here, 4-1, held it throughout all of this and got out right here. Nice, right? Then we got into DLTR. We got into it, 429. Let's see here, 429. And we got out of it right there. Right there. We had it for 4 days. Just got in right here, got out right there. Nice juicy 20.35% gain, held it for 4 days. We're still making money, and that's not it. Those were top alpha stocks. This was for PGR for Sniper. We got in 425. Let's see here, right there, right there. We held this for 7 days, and we got out on 5-2, which is right here. So got in here, got out right there, 20.34 gain, 7 days. First trade, 34 days. Second trade, 4 days. Third trade, 7 days. COP, Dollar Tree, and PGR. And maybe we'll even take another one off the table today. But we've been doing pretty good with the trades. Again, it depends on the service, but we've been doing pretty good on the trades. And again, the market right now is very, very volatile. We still have earnings right now. Next week, I think things are going to slow down because earnings will be behind us. But I believe the market is coming near the low and trying to squeeze you guys out. Don't let it happen to you. Stay defensive. Stay in utilities, energies, and consumer staples. Stay in defensive stocks and start looking at basic materials. I like basic materials. Now, folks, there's an inverted yield curve while a lot of big stocks are down over 40% and the GDP has gone negative. There you have it. And according to Jeff Zananeri, who knows the market as well as anyone, it's only going to get worse. If we aren't prepared for what could be the hardest year of trading in our lifetime, that's right, then it's time for you guys to literally wake up. Look, there's no way of knowing what the market will move or do next. That's why Jeff's gearing up to take advantage no matter what direction the market heads into. Click the link below to watch Jeff's presentation on the strategy he's using right now. Folks, Jeff managed $700 million. This guy knows what's going on. Follow the link below. Check out Jeff's presentation. You guys are going to love it. If you can't find the link, go to the YouTube Wealth Press channel. It's in the descriptor. Bye, guys. Talk to you soon. Have a great weekend. Send me an email, support@marketgeeks.com. I want to hear from you. I'll answer your questions. Check your spam folder. I always respond. Bye, guys. Have a great weekend.